You've seen the headlines, right? Billionaires paying less in taxes than their own secretaries. You hear that and you think, how is that even possible? I mean, if you or I try to get creative on our taxes, that's a crime. But when the ultra wealthy do it, suddenly it's just smart business. So in this explainer, we're going to pull back the curtain and see exactly how they legally get away with it. So yeah, how do they pull it off without landing themselves in a world of trouble? Well, the big secret isn't that they're all master criminals. The secret is that they're playing a completely different game with a different set of rules. You see, one path is illegal tax evasion, but the other is the perfectly legal and kind of mind-blowing world of tax avoidance. And here's how we're going to break it all down for you. First, we'll look at the shady side of things, illegal tax evasion. Then, we'll get into the legal playbook, the pro-level stuff for tax avoidance. We'll even touch on a common delay tactic you might actually use yourself. And by the end, you'll see the massive difference between the two. Okay, let's start with this whole zero tax mystery. It really all boils down to two very, very different paths you can take to lower your tax bill. One path, well, it leads to handcuffs and maybe even a jail cell. The other path leads to, a treasure chest. One is a crime, the other is a strategy. And this slide right here lays it all out. On one side, you've got tax evasion. That's just straight up hiding, lying, and breaking the law. But on the other side, you've got tax avoidance. Think of that like navigating a super complex maze of rules to find the shortcuts. It's not about breaking the rules, it's about knowing those rules better than the people who wrote them. Let's start with the illegal path first, because that one's easier to wrap your head around. All right, section 2, illegal evasion. This is the stuff you see in the movies, right? Outright cheating the system. This is what gets people into some serious hot water with the tax authorities. And really, it's just fraud. Plain and simple. So this illegal stuff usually boils down to three main tricks: not telling the government how much money you really made, hiding your money where they can't possibly find it, or just flat out lying about your expenses. Okay, so the first tactic is super straightforward. You just lie about your income. Let's say, for example, you sell a house for $700,000. But to dodge the full tax bill, you and the buyer cook up some fake documents saying the sale price was only $500,000. By pretending that $200,000 doesn't exist, you could illegally pocket an extra 20 grand that should have gone to taxes. It's a simple lie, and yeah, it's a crime. The second tactic is hiding your assets. This is where you hear about so-called tax havens. These are countries with super low taxes and really strict financial privacy laws. For years, Switzerland was the classic example. You could open a secret bank account, stash your money there, and your home country's tax agency would have no idea that money even existed. You're not just underreporting anymore, you're trying to make the money totally invisible. Also, highly illegal. And the third major tactic is claiming deductions that are just fake. Let's use Sarah's pizza place as an example. Say she earns 100 grand. Now the government lets her deduct legitimate business expenses before she pays tax on her profit. She actually spends $3,000 on some renovations, but when she files her taxes, she lies and says she spent $30,000. By inflating her expenses, she's illegally shrinking the amount of profit the government can tax. She's not being clever. She's literally just inventing expenses out of thin air, and that is pure fraud. And here's why people are tempted to take that risk. I mean, just look at this chart. If Sarah had been honest about her expenses, her take-home profit would be about $56,000. But by committing fraud, it jumps all the way up to $83,000. That's a huge incentive for sure, but the risk of getting caught is even bigger. Okay, so that's evasion. It's about breaking the law. Now, let's switch gears and see how the super wealthy play the game legally. All right, now for the mind-bending part. Legal tax avoidance. See, if evasion is about breaking the rules, avoidance is about mastering them. This isn't a crime. In the world of high finance, this is what they call smart financial planning. It's a whole different ballgame. So one of the classic plays in the book is using something called a controlled foreign corporation, or CFC. A big company will set up a smaller company, a subsidiary, in a tax haven, a country with little to no corporate tax. This lets them legally shift profits from a high-tax country like the US into that low-tax haven. And maybe the most famous real-world example of this involves a company you've probably heard of, Apple. And this is where things get truly wild. Check this out. For years, Apple exploited this bizarre mismatch in international tax law. You see, US law said, we tax you based on where your company is incorporated. But Irish law said, we tax you based on where your company is managed. So what did Apple do? They set up a company that was incorporated in Ireland, but they managed it from the US. The result? This company wasn't considered a tax resident in the US or in Ireland. It was basically a ghost company, existing in this legal, tax-free limbo. Pretty incredible, right? So, what was the payoff for this brilliant little legal trick? A staggering $44 billion. That's what Apple legally avoided paying in taxes in just a 4-year window. To put that number into perspective, that's enough money to fund NASA's entire budget for 2 full years. And it was all done just by reading the rulebook and finding the gaps. Okay, another big one you gotta know about is called transfer pricing. Now, this sounds super complicated, but the concept is actually pretty simple once you see it in action. So let's imagine a hypothetical company. We'll call it Wee Wee Shoes to see how this works. Okay, so here's the playbook. First, Wee Wee Shoes in the US sets up a shell company in a place like the Cayman Islands, where the corporate tax rate is a nice, round 0. Then, it transfers its most valuable assets, like its brand name and patents, over to that Cayman company. Now, for the US company to use its own brand, it has to pay massive licensing fees to its own Cayman subsidiary. This has the effect of shifting almost all the profits out of the high-tax US and into the no-tax Cayman Islands. And the result is just stunning. As you can see on this chart, before pulling this move, Wee Wee Shoes owed $350,000 in US taxes. Afterwards, that tax bill plummets to just $70,000. That's $250,000 in savings, achieved legally just by paying themselves in a different country. Now, there is one more piece to this whole puzzle. It's called tax deferral. This is a tactic that a lot of us actually use, like with a 401k retirement plan. But hold on, is just delaying your taxes the same thing as avoiding them? And the key word here, you guessed it, is deferral. This strategy doesn't actually get rid of the tax you owe. It just pushes the payment further down the road. You're not reducing the total amount you owe the government. You're just changing when you have to pay it. And you're probably way more familiar with these than you think. Things like contributing to a 401k or an IRA are common forms of tax.